Hello, I'm Juliette Sarli. In this week's edition of IG Macro Intelligence, we take a look at the energy sector amid geopolitical risks. One year on from the initial breakout of the Israel-Gaza conflict, the world remains on edge for a potential all-out war in the Middle East. There has been a flurry of activity in the crude oil options market as Israel's defense minister declared all options were open for retaliation against Iran following Tehran's missile attack on the 1st of October. Oil traders and hedge funds have reversed their bearish positions sparked by waning demand from China, turning the most bullish on crude options in 2 years, according to Bloomberg data. Brent crude also climbed above $80 a barrel, marking its highest price since August, as rising tensions spark concerns that Israel might target Iran's oil infrastructure. Goldman Sachs has indicated Brent crude could surge to the $90 a barrel level if Iran's oil supply is disrupted, while US President Biden called on Israel to consider options other than striking oil fields. OPEC claims to have enough spare capacity should Iran's oil facilities be knocked out. However, the global oil supply could become imbalanced if Iran retaliates in a tit-for-tat strike in the Gulf. AMP economist Shane Oliver says the direction of the oil price and subsequent moves in the energy sector depends on Israel. Meanwhile, Louise Bedford from the Trading Game told AusBiz she sees technical signs the sector is cooling.
Got a long green candle closing at or near its high. So what we would be looking for here as an interesting little component of technical analysis is it going to get up to that blue line, that second blue line there, the lower of the two, and do a change of polarity, which is change direction and keep going back down? Or is it going to break through? So we have got a potential, we could have a changing of the guard here with energy, but for the moment, from the technicals, it is cold.
Well, the other major factor is demand from the world's #1 oil importer, China. According to the International Energy Agency, Chinese oil demand is currently firmly in contraction, falling by 1.7% or 280,000 barrels a day year on year in July. That's a marked contrast with the 9.6% average pace of growth in 2023. Chinese officials attempting to boost economic activity through targeted stimulus measures, but sluggish growth and the switch to cleaner, lower carbon fuels and EVs is dampening oil demand. ASX TradeWatch data shows investors see little reason to hold Santos shares at current levels and should proceed with caution in buying into the recent rally in Woodside Energy. However, Ord Minnett just upgraded Santos to a buy with a price target of $8.40, and the median outlook on the stock is also a buy according to Refinitiv data, with an average $8.20 price target, suggesting a gain of around 12.5% from current levels. Woodside Energy is Australia's largest independent dedicated oil and gas company. Its shares appear to be in a strong near-term rally, according to ASX TradeWatch Trends. The average recommendation on Woodside shares is a hold, according to Refinitiv. Citi, though, has a sell with a price target of $23.24. Macquarie's target price for Woodside is $33, and the broker sees the stock outperforming as the producer keeps its cost controls in check despite the inflationary environment. And that is your IG Macro Intelligence for this week. We'll see you next week.